We did receive the quarterly data. It was released in early June. We saw the euro area economy expanded by 1.5% year on year for the first quarter, and that was 25% higher than the 1.2% in the previous estimates, and the strongest annual performance since Q2 of 2022. This follows a 1.2% rise in Q4 of 24. Gross fixed capital formations rebounded, and both exports and imports also rose faster. In contrast, smaller slowdowns were seen in households and government spending. Among the bloc's largest economies, we saw the German GDP stall, but expansions were recorded in France, Italy, Spain, and the Netherlands. When we then correlate that into the inflation story here, we saw the Euro Consumer Price Index rose slightly to a reading of 2% year on year in June, up from the May's 8-month low of 1.9 and in line with market expectations and also their targeted range. The figure aligns with ECB's official target. Among major economies, inflation in Germany unexpectedly declined, whilst in France and Spain saw modest increases and Italy's rate held steady. Services inflation, which is the one we always want to look at, accelerated to 3.3%, up from May's 3-year low of 3.2%, whilst the decline in energy prices softened to 2.7% from a reading of 3.6%. In contrast, inflation eased for non-energy industry goods and for food, alcohol, and tobacco, and core inflation, which excludes those energy and food prices we talked about, was unchanged at a reading of 2.3%, making it the lowest since January of 2022. What did that mean for interest rates? Well, we got an interest rate cut on the 5th of June from the ECB, delivered its 8th straight interest rate cut in its last meeting. Maybe the RBA needs to go and see what they're doing over there.
Well, not just that. What I wanted to sort of talk about with that is that going back to this screen, if you have a look at the inflation read, right, and where the inflation is there,
paint that to ours.
Paint that to this with what's going on. Is that we got a bit of a flick up when the ECB first started, because they did actually shoot the gun. They went a half, not just a quarter. They went a half. When they saw it wasn't moving with the first, because they did a quarter, and then they went, okay, bang, we need to really go. And they've been going ever since. It hasn't led to a stoking of inflation.
No, it hasn't.
And
a little bit of services inflation in there.
Yeah. So it's interesting. So let's come to the key takeaways, because it's true. GDP is improving. We need to point out, and I'm glad you put the equity markets in Europe are actually one of the best equity markets on the planet at the moment. And that's despite, all this stuff around auto tariffs and the threats of tariffs for the Eurozone as a whole. They are now changing their behavior. They're looking to other markets. They're looking to other opportunities. So instead of looking across the Atlantic and across the ditch, they're actually looking east, and they're looking into even as far east as us. And so the euro is an interesting one. It's going to have problems, right? It's an ancient part of the world. It does have, therefore, legacy economic constraints, but it's growing, and that needs to be clearly pointed out. That the ECB, I actually think, has possibly got it slightly right in the fact that they've looked through short term, and they're like, actually, no, we can see the data is going to be pretty flat, and we can get ahead of the curve. And if we do need to slow down or put the brake on a little bit, we can do that in the future. Because Germany's not blowing away, but that's fairly standard. It's more, you look at France, you look at Italy, and particularly players like Belgium and Netherlands that are what they call the tier 1 peripheries. They are actually showing that they're growing, let's use the term, humming along at about 1 to 2% for Eurozones. That's really good, and that's what they want.
Yeah, and I think this, as much as the defence spending, which has been flagged as part of the NATO, so it's either 3% of GDP or 5%, I think, is what they want to move it to. It's around that number,
whatever it is.
But that is certainly, from a debt point of view, one to watch. But
it's also your point on that is where they're looking. Right?
Well, they're going to have to invest in themselves, in their own R&D,
and they've made it clear that the US is not where they're going to go, because the US is doing this. So, Czech Republic is the one to highlight. Is that Germany's change has said, actually, we're going to invest in drones, and instead of going to the US, which we would have gone to, next door to us, one of the best drone makers on the planet is the Czech Republic, and away you go. So
and here we are. So it is interesting, and I think that's something that the decoupling from the US, from the rest of the world goes. Yes.
Czechia. I know you've changed your name. I do apologise. It's not the Czech Republic anymore.
Oh, yeah. So, but I think there is a decoupling off the back of this. How do you treat your friends and your allies? And I know that the US is trying to, at the end of the day, it's all about, nationalism is what we're seeing coming out of the Trump camp. So that's an agenda that he's set, and that's what he's been elected on. So he's going to try and live out that agenda.